The JSE is contending with mixed global markets today as China battles COVID-19 waves. Case numbers have more than tripled. Markets are also focused on the potential for peace in Ukraine. For more on these and other business stories, we're joined by Petri Redelinghuys, trader and the founder of Herenya Capital Advisors. A happy Monday to you. Give us a sense of how the local markets are performing thus far at midday trade.
Good afternoon, and not the happiest of Mondays for the JSE. Our market is down around 2.25% at this stage. The Naspers process combo feeling a huge amount of pain, and really we're seeing a relatively broad-based market sell-off. Financials are surprisingly resilient, and also a special shout-out to Capitec for performing really well given the current circumstances. But it's definitely risk off coming into this week. I think both from a sort of global macroeconomic risk as well from a local perspective. Naspers is causing quite a bit of pain, and there's some sort of company-specific things that are causing that risk. Namely a couple of regulatory moves from China. The most important one I think to speak about is that Tencent is receiving the biggest fine ever given by Chinese authorities for money laundering. So now I don't really have too much detail other than that at this stage. I mean, they stand accused of money laundering. Exactly how, where, when, and why, those details I do not have yet. But this is potentially catastrophic for the stock, right? Well, we can see the way that Naspers is trading. It's down some 13.9% at the moment. It's already had one volatility auction for the day. It's been a rough day, and this is, on the back of a capitulation in Tencent as well. So a lot of people getting relatively hurt with this today, and also between the two Naspers process, it still does make up quite a fairly sizable chunk of the top 40 index. So as it's coming off, it's dragging the rest of the market down. But there are also other bigger sort of macroeconomic headwinds that are bringing some fears into the market as well. I mean, we look at S&P 500 futures currently trading slightly positive from where we closed on Friday, but China's going back into lockdown. They're locking down Shenzhen. It's like the third biggest port in the world. Supply chain issues much on the cards maybe. So there's a lot of fear and confusion and a lot of things working together, I think, today to create a little bit of uncertainty, right? Well, quite a bit of uncertainty, really. What's interesting is that, over the weekend we saw some good news in terms of peace talks between Russia and Ukraine, but then also Russia formally asked China to give them military support for their activities in Ukraine. China has not yet responded, but there's just a lot of unknowns at this stage, and the market is not a big fan of uncertainty.
A lot of unknowns. What do we know about oil prices for today, at least? Any notable moves?
So for today, it's down 3.6% at this stage, so trading in London at about $108.26 a barrel. So that is cooling off quite a bit. But I'm not so sure that that's going to be, I don't know. Again, this is one of those things that you don't want to, I don't want to put my head on the block here and say, well, that's it, we've seen the top in oil. Any sort of escalation into the Russian situation or Russia-Ukraine situation might lead to higher oil prices as well. And we're also seeing quite a few countries kind of moving to ban Russian imports. Interestingly enough, some countries, Brazil, for example, coming out and saying that, well, we'll buy oil at a discount from Russia because, it's cheap and we need oil. We need the energy, right? We've seen, strangely enough, over the weekend, power utilities in the U.S. under some pressure as well. So people are being asked, please don't charge your electric cars. Energy comes from somewhere, and unfortunately the majority of it at this stage still comes from dirty fossil fuels, coal and oil, right? So for now, the energy price is coming down, but even if you look at something like just the volatility of the oil price is at really extremely high levels. So 3.5% down now could be 3.5% up by this afternoon. I think for now, caution is absolutely advised. And I don't think that, even if oil prices continue to come down in the short term over the next week or so, I don't think the situation with Russia-Ukraine is, it's not going away. So I think we're in for just maybe not necessarily higher prices, but I do think it's going to be, and when I say higher, I don't mean higher than 130, right? I think we're going to see quite a bit of volatility between sort of the $100 and the highs that we made recently, 130 mark for some time, unless there's some sort of amicable solution with the Ukraine-Russia situation in the very short term.
As you mentioned, the situation between Russia and Ukraine is not going away. A number of companies are, though. British American Tobacco has opted to exit Russia. Talk us through that development.
So, yeah, this is actually, I guess, just a fallout of some of the sanctions that we've seen. British American Tobacco actually took a bit of ridicule just prior to the weekend, because they were one of the companies that came out and said they were going to continue selling cigarettes to Russia. Other companies like McDonald's and sort of all sorts of KFC, junk food outlets, lots and lots of sort of Western US-based or founded, at least, companies are pulling out, right? And some of the companies like Shell, for example, Shell came out and said, well, look, we're going to continue to buy Russian oil because we're in the oil business and Russian oil is cheap, and they took quite a bit of flack for that as well. And then eventually did a 180 on that stance as well, and then also decided to no longer do any business with Russia. And British American Tobacco is now the next one to do that. So, as time goes by, we'll probably see more and more companies sort of shunning Russia. You have to ask yourself, though, what is the long-term economic impact of that, right? I mean, if this situation is not resolved and trade doesn't go back to normal, we really have to almost reshape global supply chains. It's we're in for an interesting year for sure. And also, another thing just to mention, later this week we have the Fed, right, coming out with a FOMC statement. So basically, we're going to be hearing what the fate of interest rates in the US is. And I think I've said previously while chatting to you that I think it's very unlikely that we're going to see more than 3 interest rate hikes, given market is kind of pricing in 7, but it's maybe a bit being unrealistic. I retract that now. I think there's a number of different things. This Russia-Ukraine conflict, obviously because of the energy impact it has on energy prices, will add inflationary pressure. Also, a fresh lockdown of something like 17 million people in China and the 3rd biggest port in the world just being closed again with no real guidance as to when it's going to be open. Again, that's going to be that supply chain sort of bottleneck kind of driven inflation. Plus, we have the huge amount of money that's been printed. And I think a lot of people are blaming Russian situation or supply chains or whatever the case is. But a lot of this inflation is being driven by the fact that the U.S. printed like 1/3 of all the U.S. dollars that's ever existed in the last 2 years, right? All of those chickens are almost coming home to roost at the same time. So I revise my view that we might not have 3 interest rate hikes this year. I think we probably see a very strong and steep one even as early as this week. It's looking fairly grim, right? I mean, there's basically a number of different things that create recessions, and we've almost got all 3 of them. We've got a commodity price shock, we've got slowing economies, and we've got tightening monetary policy. It's going to be a rough year.
Let's end off with some good news, shall we? At least for shareholders of private higher education group Stadia. They've declared their first dividend, with shareholders set for a 40 million rand payout.
Yeah, so some good news for Stadia shareholders. Look, unfortunately, you couldn't have picked a worse time to put good news out, right? So the market perhaps not responding to it as positively as what it would have under different circumstances. So the share is only up around 1% at this stage. But you're getting a 4.70 rand dividend. Okay, less 20% for dividend withholding tax, but a fairly decent dividend on a 3.33 rand share is fairly decent, right? What's interesting there, or what's exciting, I suppose, is last year they had a headline loss of just under 140 million, and this time they had a headline profit of just over 130 million, or just under 140, right? So they had a complete swing from being in a position of loss to being in a position of profit, and they've sort of started streamlining. They took a few impairments here and there along the road, but started streamlining their operation to be a bit more future-proof, if you will, more for remote learning and that kind of stuff. And that's really starting to pay off, and I think that it's great news for shareholders, I guess. It's not necessarily one of those stocks that is going to run 1,000% in the next 2 years, but it's going to be one of those stocks that's going to be a cornerstone. It has its niche in our market. It's very defensive. It's got a strong moat around it. And, even if you look during all this pandemic and madness, the share price has performed relatively well, and will probably continue to do so for some time to come.
Petri Redelinghuys from Herenya Capital. Thank you very much. A negative outlook for the year, but maybe we can have a positive day today. Let's let you go to enjoy that.